Good day, everyone. We are the Alpha Consulting Group, your strategic consultants here to present an external analysis of Dutch Bro's business environment. In this presentation, we will examine the key opportunities and threats shaping the industry while also studying its major competitors in the coffee shop market, namely Starbucks and McCafe. In this analysis, we will explore Dutch Bro's external environment by conducting an industry analysis and a detailed rival analysis focusing on Starbucks and McCafe. Let's begin by looking at the broader landscape, starting with an industry analysis to better understand the competitive environment in which Dutch Bros operates. Starting with Porter's five forces, the threat of new entrants is weak to moderate, driven by the industry's lucrative growth. Established players benefit from economies of scale, supplier agreements, and efficient distribution, but market expansion attracts new competitors. Low switching costs and consumer openness to new brands reduce entry barriers, enabling emerging coffee shops to challenge incumbents. While established brands leverage supplier ties and prime locations, shifting consumer loyalty strengthens buyer power and eases entry. The threat of substitutes is also moderate to strong, with a 14.2 billion US dollar substitute market projected to grow at 4.7% CAGR to 2032. Health trends, demand for caffeine-free and sustainable products, and preferences among millennials and Gen Z for convenient, wellness-focused options fuel competition. Alternatives like energy drinks, teas, and functional beverages raise switching ease and pressures traditional coffee offerings. Supplier power is moderate to weak due to fragmented global production and abundant sourcing. Commodity suppliers hold weak leverage given the vast supply and low switching costs. Buyers can diversify sources or integrate supply chains. Specialty beans hold moderate power due to exclusivity. While large agribusinesses influence trade, buyer dominance and substitutes like mushroom coffee limit their power. Climate risks may raise leverage temporarily, but commoditization and buyer strategies constrain it overall. Bargaining power of consumers is moderate to strong. While individual consumers are numerous and fragmented, limiting their collective influence, several factors shift power in their favor. The market is saturated with competitors, switching costs are low, and customers can easily choose substitutes or brew coffee at home. Buyers are often well informed about pricing and can delay purchases without significant impact. However, product differentiation through branding, ambience, and specialty offerings helps coffee shops retain some control. The competitive threat in the industry is strong. The market is packed with global brands, regional players, and local upstarts, all competing in close quarters. Many firms are similar in size and strength, thus pushing head-to-head battles. High fixed costs, perishable inventory, and aggressive expansion strategies add pressure to sell fast and often fueling frequent price promotions. While some chains differentiate through ambience or mission, easy customer switching and crowded urban markets keep price, speed, and convenience at the core of competition. In this saturated industry, no player can afford to ease up. Now let's look into the PESTLE analysis. For political factors, trade barriers like US 10% tariffs and 15 to 20% surcharges on Brazilian coffee disrupt supply chains and raise import costs. Regulatory compliance further increases operational expenses, impacting profitability. For economic factors, the global coffee market was valued at $223.78 billion in 2023 and is projected to grow at 5.4% CAGR through 2030. The US leads with 5.5% CAGR, while segments like ready to drink with 6.4% and organic 7.4% outpace average growth. E-commerce and subscriptions drive B2C sales. Asia Pacific grows at 6.1% as coffee culture expands in China, India, and South Korea. Coffee shop revenue is expected to rise from $78.96 billion in 2022 to $133.98 billion by 2030, driven by premiumization and urbanization. For social cultural factors, millennials and Gen Z, which consists of 52% of the global population, drive demand. Europe dominates takeout coffee with 35% share, while US coffee consumption remains high. 73% drink coffee daily, 51% visit shops weekly, and 87% show strong loyalty. One third of Americans aged 18 to 29 years old visit shops recently. 49% prefer medium roast and 66% brew at home. 31% spend $11 to $20 per month on home coffee, while 11% spend over $40. For technological factors, digital platforms, apps, and e-commerce enhance customer access. Smart farming and climate-resilient Arabica improve yield efficiency. Innovations like solar-powered mills and energy-efficient dryers reduce emissions and align with sustainability goals. And for legal factors, FDA mandates and CGMPs raise production and labeling costs. Labor laws like California's AB 1228 increase expenses. On the positive side, H.R. 965 supports USDA research to combat pests and disease, offering long-term crop protection. And lastly, for environmental factors, climate change threatens 50% of growing regions by 2050, risking a 20 to 30% drop in yields. Coffee causes 5% of global deforestation, with shipping and transport contributing up to 26% of emissions. US states enforce strict environmental laws, pressuring businesses but also driving demand for eco-friendly packaging and climate-adaptive crops. Now let's explore the strategic group maps. In the coffee shop chain industry, competitors can be mapped based on two key factors: convenience and quality of coffee and the menu. Most players aim for high convenience, but three main strategic groups emerge. First, artisanal shops like Blue Bottle focus on quality over speed. Second, chains like Starbucks and Dutch Bros. They strike a balance between high quality and high convenience. Lastly, brands like Dunkin' and Tim Hortons offer widespread accessibility with more basic offerings. Dutch Bros competes most closely with Starbucks and Costa, making them its primary strategic rivals. Finally, we'll discuss the future key success factors that are crucial for succeeding in the coffee shop industry. First and foremost, the quality of our coffee and menu offerings must be exceptional and consistent. Customers expect great taste and variety, and without this foundation, everything else falls short. Equally important is customer service. Friendly, efficient, and personalized interactions create memorable experiences that encourage repeat visits and generate positive word of mouth. In addition, location plays a crucial role. Being situated in high traffic, easily accessible areas, especially with drive-through options, greatly enhances customer convenience and increases footfall. Moreover, a welcoming and comfortable environment invites customers to linger and return. A distinct and appealing atmosphere helps us stand out in a competitive market. Lastly, community involvement is key. Actively supporting local events and engaging with customers on social media strengthens loyalty and builds meaningful connections beyond just serving coffee. Now that we've covered the industry analysis, let's shift our focus to examining Dutch Bros' competitors and their position in the market. Let's begin by examining the financial performance of Starbucks and McCafe. First, let's talk about Starbucks' top-line growth. Over the past 5 years, total revenues grew from 23.5 billion in 2020 to 36.2 billion in 2024, which is a solid pace. Licensed stores were the fastest growing segment, while other revenues declined slightly. Now let's look at costs. Starbucks has done well controlling expenses. However, store operating expenses jumped 3.9% in 2024, likely due to inflation or higher labor costs. However, it's not all smooth sailing. Starbucks faces liquidity risks. The current ratio fell from 1.06 to 0.75, meaning short-term liabilities now exceed current assets. Cash reserves dropped from 0.59 to 0.36, and working capital turned negative in 2022 with negative 2.1 billion and worsened to negative 2.2 billion in 2024, a red flag for short-term financial health. Long-term solvency is also shaky. Interest coverage is negative, with negative 9.62 in 2024, meaning operating income doesn't cover interest expenses. Liabilities exceed assets, with a liabilities ratio of approximately 1.25. Shareholders' equity is deep in deficit, with negative $7.4 billion in 2024. The good news? Gross margins improved as COGS dropped from 32.7% to 30.9% of revenue, and operating margins doubled from 6.6% to 15%, driving net profit margins up from 3.9% to 10.4%. On efficiency, Starbucks improved. Inventory turnover rose from 4.96 to 6.29, a better stock management. Asset turnover jumped from 0.80 to 1.15, meaning more sales per dollar of assets. Next, the DuPont analysis explains why ROE is still negative, with negative 51% in 2024. Profitability improved, efficiency improved, however, leverage worsened. Hence, excessive debt and equity deficits are dragging down returns. Now, McCafe's total revenue fluctuated, peaking in 2021, then declining in 2022, and recovering in 2023 and 2024. Net income significantly grew in 2021, followed by a decline in 2022, then a recovery in 2023, and a slight dip in 2024. Also, there is a sharp decline of cash and cash equivalents in 2024 with negative 76.3% due to possible large investments or debt repayments. Its long-term debt consistently increased, reflecting reliance on debt financing. McCafe is asset heavy, with most value tied to lease right of use assets with approximately 25% and net property and equipment approximately 45%. Franchise revenue grew steadily while company related sales remained stable. Other revenues, which are approximately 1 to 2%, are minimal, showing reliance on core operations. Current assets at 8 to 15% declined in 2024, which is around 8.3%, signaling tighter liquidity. Food and paper and payroll are major cost drivers. Operating margin improved from 38.1% in 2020 to 45.2% in 2024, reflecting cost efficiency. As for financial ratios, the current ratio has improved, but the 2024 drop in cash raises concerns. Cash ratio had a sharp decline, indicating reduced short-term solvency. For solvency ratios, liabilities ratio is around approximately 115 to 120% since liabilities exceed assets, typical for capital-intensive firms. And interest coverage from 6.0 to 7.8 showed a strong ability to cover interest expenses. Gross margin is stable with a slight improvement, and return on equity from 2020 at negative 60.5%, which is due to shareholder deficit, became negative 2.16.5%, which was worsening, likely from buybacks. Return on assets improved asset efficiency, and activities like inventory turnover are extremely high, typical for fast food with low inventory. And finally, asset turnover, which is at 0.36 in 2020, improved at 0.47 in 2024, meaning it has better utilization of assets. As for the DuPont analysis, profitability improved from 24.6% in 2020 to 31.7%. Efficiency showed better asset use from 0.36 to 0.47, and leverage is negative due to shareholder deficit from buybacks. Hence, ROE is negative, driven by high leverage and retained earnings fluctuations. Now let us dive into the financial health of the three coffee chains by comparing their profitability, liquidity, efficiency, and return on equity to see who's brewing success. So, who wins? Dutch Bros is the most balanced, Starbucks is efficient but over-leveraged, and McCafe is profitable but collapsing under debt. Next, we'll analyze the value chains of both companies to understand their operational efficiencies. First up is inbound logistics under primary activities. First, Starbucks sources ethically and roasts in-house across global facilities and has tight vertical control, whereas McCafe uses McDonald's large-scale suppliers and is efficient but limited sourcing transparency. Under operations, Starbucks operates 19,000 plus company stores with modernized layouts and high partner training, whereas McCafe integrates into McDonald's franchise restaurants, offering standardized, scalable operations. For outbound logistics, Starbucks delivers via app, in-store, drive-thru, and Nestle's global retail network. McCafe benefits from 40,000 McDonald's locations and the 4D principle, or the delivery or drive-thru strategy. For marketing and sales, Starbucks leads with personalization, seasonal campaigns, and a 30 million plus rewards base. McCafe markets through McDonald's app and viral national campaigns. And finally, for services, Starbucks prioritizes premium in-store experiences with trained baristas, whereas McCafe offers efficient, no-frill service focused on volume. Moving on to support activities, first we have this infrastructure. Starbucks operates on a hybrid model, global roasting network, and direct store ownership. McCafe, on the other hand, is fully embedded in McDonald's franchise network. Under HR management, Starbucks offers extensive benefits and advancement pathways, whereas McCafe focuses on franchise managed labor with centralized McDonald's training. For technology, Starbucks has AI-driven personalization, digital ordering, and predictive scheduling, whereas McCafe uses McDonald's tech stack, AI menus, dynamic pricing, and loyalty platform. As for procurement, Starbucks directly sources and has in-house control over equipment and coffee, whereas McCafe functions through franchise-based procurement from vetted global suppliers. So each brand creates value through distinct approaches. Starbucks is built on vertical control and premium personalization. McCafe is optimized for scale, speed, and integrated digital delivery. Dutch Bros thrives through agile execution, cultural service, and drive-through leadership. Their adaptability across value chain components will shape how they compete and grow as consumer expectations continue to evolve. Let's now examine the current strategies of Dutch Bros and compare them with its two main competitors through the lens of corporate, business unit, and functional strategies. At the corporate level, Dutch Bros aims to reach 2,029 stores by 2029 with a strong focus on company-operated growth in high-potential U.S. markets. Starbucks, in contrast, is pursuing global expansion with a target of 55,000 stores, while McCafe is integrated into over 40,000 McDonald's locations using McDonald's infrastructure for scale. At the business unit level, Dutch Bros differentiates through its youth-focused menu innovations like boba and protein coffee, plus drive-through and walk-up formats supported by its Dutch Rewards app. Starbucks focuses on premium tech-driven experiences through its AI personalization and diverse store formats. McCafe simplifies its menu to focus on core coffee products and cold beverages, catering to fast, affordable service. And finally, at the functional level, Dutch Bros stands out with operational efficiency, using a 4-month inventory buffer, commodity hedging, and AI-driven staffing. It also prioritizes employee development via Dutch Bros University and invests in community engagement. Starbucks emphasizes sustainability, employee culture, and AI-enhanced service. McCafe improves operations through standardized equipment, mobile ordering, and localized customer experiences. In summary, Dutch Bros excels in people-first culture, operational control, and digital loyalty, while Starbucks leads in global innovation and McCafe thrives on convenience and scale. We'll then assess the resources and capabilities that drive their success using the VRIO framework, which stands for valuable, rare, costly to imitate, and organized to capture value. In terms of physical resources, Starbucks leads with a sustainable advantage in global infrastructure, while Dutch Bros and McCafe have temporary advantages in roasting facilities and real estate. Financially, Starbucks and McCafe both maintain temporary advantages in cash reserves, respectively, while Dutch Bros has competitive parity in revenue growth. And for technological resources, Starbucks dominates with sustainable digital platforms, whereas McCafe has temporary and Dutch Bros with parity advantages. Next, for intangible resources, all three have temporary advantages in brand equity. However, Starbucks stands out with sustainable supplier alliances, whereas others are temporary. While for culture and HR, all three show competitive parity in human capital with no standout advantage. Last is the capabilities. For operational efficiency, Starbucks has a sustainable edge in supply chain management, while McCafe and Dutch Bros have a temporary advantage. Moreover, Starbucks again leads sustainably as others innovate but lack rarity. For marketing, Starbucks' customer engagement is sustainable while others rely on temporary loyalty programs. And finally, for growth execution, Starbucks has a sustainable edge in expansion while a temporary advantage for McCafe and Dutch Bros with competitive parity. So in summary, Starbucks emerges as the clear leader with multiple sustainable competitive advantages, particularly in technology, operations, and supplier relationships. Dutch Bros and McCafe, while strong in certain areas, rely more on temporary advantages that competitors could replicate. And finally, we'll critique the strengths and weaknesses of Starbucks and McCafe in the competitive landscape. So Dutch Bros as an emerging challenger has 831 stores across 16 US states and is heavily focused on drive-thru service and energy drinks. Its strengths include exceptional drive-thru efficiency and layout design, strong resonance with younger consumers, and proprietary Blue Rebel energy drink drives product differentiation. Its weaknesses include still domestically concentrated, transition to company-owned stores, raises operational overhead, and lower international brand recognition compared to incumbents. Starbucks as the premium global leader has over 38,000 locations globally and is a leader in specialty coffee. Its strengths include strong brand equity and premium appeal, advanced digital ecosystem, and dominant global presence across key regions. Its weaknesses, however, include high operating costs, particularly in labor and leases, drive-through model is not as optimized for speed as competitors, and menu complexity can affect order turnaround times. McDonald's or McCafe as a scale and efficiency giant has 40,000 plus global locations and has McCafe embedded within the QSR footprint. Its strengths include unrivaled scale and supply chain advantages, cost leadership attracts value-driven consumers, and ongoing investment in AI and automation enhances drive-through speed. Its weaknesses include McCafe lacks specialty coffee prestige, brand is more aligned with value than quality, and franchise models can lead to inconsistencies across regions. So in conclusion, Dutch Bros is a nimble disruptor leveraging speed and youth branding. Starbucks leads in brand power and global footprint but faces margin pressures, whereas McDonald's dominates on cost and convenience yet trails in premium coffee identity. Strategically, these players represent distinct pathways to consumer value, with Starbucks banking on experience, McDonald's on scale, and Dutch Bros on speed and culture. In conclusion, we've examined the industry landscape, analyzed key competitors like Starbucks and McCafe, and assessed their financial strategies and resources. This comprehensive analysis provides valuable insights into the competitive environment Dutch Bros operates in, highlighting both the opportunities and challenges they must navigate to sustain growth and success in the future.